Hello, everyone, and welcome back to the Peterson Institute for International Economics. I'm Adam Posen, the Institute's president, and it's my pleasure to moderate today's semi-annual Global Economic Prospects session led and coordinated by Karen Dynan, and joined today with topical presentations by Martin Chorzempa and Jean Pisani-Ferry. Just to remind all of you, this is one of our best events on a semi-annual basis, right ahead of the IMF releasing their World Economic Outlook. The Peterson Institute team prepares an informal forecast, but we try to think about it rigorously. And we've had a succession of distinguished economists, Mike Musa, David Wilcox, and now Karen Dynan, being the leaders of this effort. So what you're about to see, it represents the views of the individual speakers. As always, there's no Peterson House view, but this, I'm sparing Karen having to say this. I know she knows, says and believes all this, but she and others benefit from the input of our fellows. So it is Karen's view and then John and Martin's, but it is a group effort to check and come up with the right topics and the right views. We are not an investment bank. We do not provide day-to-day interpretation of data points, but we do try at this semi-annual interval to really take stock of where the consensus is, particularly on GDP growth and to some degree on inflation and policy, and where our people may differ from the consensus. And we always format this as a deeper dive on the US economy and then two relevant topics from other Peterson experts. So presenting first will be Karen Dynan, who is, of course, professor of the practice at the Harvard University of Economics. She was previously Assistant Secretary for Economic Policy and Chief Economist at the US Treasury in the second term of President Obama. And prior to that had been vice president of Brookings and for economic studies and had been a leader in the Federal Reserve staff. Importantly, Karen's research background is leading work on household savings and consumption, which is very important at the moment for trying to make sense of our crazy economic outlook. And I don't mean PIIEs, I mean the world. And that will be one of the ways in which Karen brings her insights today. Speaking second will be Jean Pisani-Ferry. John has been with us as a non-resident fellow, senior fellow for a couple of years now. John, of course, is one of the leading macroeconomists in Europe, if not the world, had played a number of senior government and advisory roles to French President Macron, highly influential in the European Commission and European capitals. And importantly for us in the think tank world, was the founder of Bruegel, the leading economic think tank in Europe and an important partner and follower of Peterson Institute. Jean recently had published an important piece of work for us at Peterson, a policy brief on the macroeconomics of decarbonization. That's not his focus today. His focus is on the European outlook, taking into account recent developments in politics and vaccines, as well as economics in Europe. And we're delighted to have Jean with us today. Speaking third is our colleague, Martin Chorzempa, who is a senior fellow at the Peterson Institute. Martin has been doing unique work at the intersection of fintech, financial regulation, and China studies. And along with our colleagues, Nicholas Larding, Mary Lovely, and Tianlei Huang, constitutes the China team we have here. Martin's cutting edge work on central bank digital currencies and various other forms of financial innovation has been cited widely, including by Governor Brainerd at the Fed and by Augustin Carstens at the BIS. And he has a new book on fintech that will be appearing from a major publisher, Public Affairs, next year. Today, however, Martin has been coping in real time with the blizzard of new regulations and interventions into the tech sector in China, and he's going to give us his interpretation of where they come from, where they're going, and their impact. So in that order, and then this is all on the record, and then we will look forward to having questions over the Zoom chat, which I will put to our speakers. So Karen, with deep thanks for your continued leadership on this project, over to you.
Thank you, Adam. I'm going to start by sharing my slides. Okay. Yeah, so thank you for that nice introduction. It's wonderful to be here, to have an opportunity to present my global economic outlook. Again, the basic theme of my presentation is that economic recovery is continuing throughout the world, but that the path has been bumpy and will continue to have bumps and risks. So let me see if I can get my slides to advance. Yeah. So this slide shows my global GDP forecast. This is the level of real GDP benchmarked to 100 in 2019. So it's easy to see how things compare to pre-pandemic days. Global GDP has been rebounding from its dip last year, and in fact surpassed its 2019 high this year, which is good news. And I'm projecting a decent pace of further economic recovery, almost 5% next year. That said, I'm not as bullish as I was earlier in the summer because of some important adverse developments, including the spread of the Delta variant, and I'll be talking much more about that later in the presentation. So let me give you a quick tour around the large economies, beginning with the advanced economies. These charts are set up in the same way, showing levels of real GDP as the previous chart. And just kind of looking across this chart, you can see that the United States remains out ahead with its economic recovery. That's because of its early start on vaccines and all that fiscal stimulus that the United States put in place. By next year, the US economy will be almost 7% larger than its pre-pandemic high. Europe is a bit behind, given some stumbles last year, but it too has really solid fundamentals, putting it on a good track as supply constraints ease, and John will be talking much more about this. I was pessimistic about Japan in April, but Japan has really stepped up its game in terms of vaccination. And furthermore, the new government looks very likely to pass additional fiscal stimulus. So I've actually marked up my forecast for Japan to 2.4% for this year and 2.9% for next year, which are kind of decent growth rates for Japan. The United Kingdom, like so many countries, is hampered by bottlenecks and supply issues. I highlighted here for the UK in particular because it was having such a strong bounce back in the spring, given its early start on vaccines. But this bounce back has really given way to kind of a sideways trend in incoming data, although I think fundamentals are very good in the UK as well, and we'll see resumed growth soon. Then turning to the large emerging economies, China continues to stand out. There are concerns about various things, including regulation, which Martin will be talking about in a minute. But after consulting with the PIIE experts, I think those concerns aren't a big deal for macro growth. So my forecast remains strong, with growth of almost 8% this year and 6.6% next year, which is higher than where consensus is right now. India has done surprisingly well, given the terrible experience it had with the virus earlier this year. I think it will continue to grow briskly, but the large decline in 2020 will still leave it behind its pre-pandemic trend. Just given how fast it grows normally, there's a lot of ground to make up. In Russia, there are cross currents, but recovery should continue there as well. The central bank tightened rates because of inflation concerns earlier this year, but it looks like there will be new fiscal stimulus in Russia, and their energy experts should do well. Lastly, Brazil is another country that has done surprisingly well this year, registering 4% economic growth. That said, again, after consulting with PIIE experts, I expect that growth is going to slow down again to about 2% next year. Brazil still has significant structural problems, and we expect political turbulence there related to the elections that are coming up in 2022. Let's see. Sorry. Here are the just a summary of the growth rates that go with the levels I just showed you. I'm not going to dwell on them, but I wanted it in the deck so you can come back to our website and download the table if you'd like. Before I go to the United States, I want to flag that although virus concerns are becoming less of an economic issue for many of the countries I just showed you, there are still lots of countries, mainly poor countries, for which vaccine access is low. You can see this in the map. And those countries are unlikely to be able to enjoy robust recoveries until their populations are largely vaccinated. And together with the fact that those countries have been constrained fiscally, this lack of vaccine access is what's producing what people are calling a two-track global recovery when it comes to the lower income countries. Now, as I said earlier, I had gotten bullish about the recovery earlier in the summer, particularly in countries where vaccination was ramping up quickly. But since then, recent developments have surprised in three related ways. So first of all, of course, there's the spread of the Delta variant, which, as we all know, is an issue even for countries with vaccine access. And second, we've seen bigger headwinds on the supply side than anticipated, having to do with supply chain problems, bottlenecks, and particularly in the United States, a reluctance of workers to come back into the labor force. The third development has been that the combination of these headwinds, along with strong demand, has resulted in higher inflation. Again, particularly in the United States, at 3.6% core PCE inflation, here is the highest we've seen since the early 1990s. I'm going to come back on all these themes. So basically, though, here's my basic forecast for real GDP in the United States. If you look at the levels of real GDP on the left, you can see the continued economic recovery I discussed before. And you can see it's not just that real GDP has surpassed its pre-pandemic high, it's going to surpass its pre-pandemic trend level by the middle of next year. And on the right, you can see the corresponding growth rates. The basic story is that we've seen a lull in growth in Q3 with Delta damping demand for services and the supply constraints I talked about earlier. But I expect that growth will come up in the winter and then stay higher, though the recovery is less front-loaded than I would have said in June. It's much more stretched out than I think I and other people were expecting. And to dig down further into what's going on, I want to highlight 5 key economic factors that are going to shape the outlook in the United States and also in many other countries. So it's whether households have the financial capacity to keep spending, when supply chain problems and bottlenecks will fade, how labor force participation and the demand for workers will evolve, what course fiscal policy will take, how inflation expectations, wage pressures, and monetary policy play out. So what I'm going to do in the rest of my presentation is I'm going to speak to each of these factors. So I'm going to start with the easy good news one, which is what's going on with household finances. And it's important because I think it's a key underpinning of aggregate demand in this country. And if you followed my work previously, you know I think we don't have timely, high-quality data that speak directly to the state of household finances, but we have lots of related indicators. And I interpret those indicators as telling a story that most households are in good shape and most lower-income households are doing better right now than they would be in a typical recession because of all the pandemic income support that we've seen. So just to highlight 2 interesting data points in this regard, on the right, I show changes in after-tax income and spending between 2019 and 2020 for different education groups. And I'm using the different education groups as a stand-in for where households fall in kind of the longer term income distribution. You don't want to use current income in this case because recessions tend to mess with the composition of the current income groups. But what I basically want you to see is that after-tax income was up for all groups in 2020, particularly at the lower end. And you can also see that expenditures are down a bunch for higher income people. That's higher income people cutting back on their vacations and their restaurant meals and so on. But what you can also see is that expenditures were either down or a little changed for the other groups, implying that those groups did saving in 2020. In fact, they probably did more saving than in normal times when we think they're saving very little. So that's a piece of good news. On the right, I'm showing you what I think are probably the best measures of financial distress right now, credit card and auto delinquency rates. And I show you these instead of mortgage delinquency rates because they're less likely to be affected by forbearance. But these rates have actually, if you look at the end of the series, they've actually come down over the past year. So I think I'm reading these signals along with a bunch of other signals as saying we'll see broad-based strength and demand for a while to come. Turning to supply chain issues and bottlenecks, I mean, the basic story, I don't think this is a surprise to anybody, is that they've been more consequential than we thought. And I think at this point, it's fair to expect that they'll ebb only slowly. So, for example, I'm showing you on the left, ships stacked up at ports. This is a graph of what's going on in Los Angeles. If you want to see even more striking examples, go look at the photos of the ships stacked up at ports. I think they're really just astonishing. And I think we think, eventually we'll fix these problems at, for example, ports. But, even if this sort of problem eases in coming months, we need to make up for the shortfalls that have already occurred. So at right, I'm showing you an example of what I mean, which is the inventory to sales ratio for domestic autos in this country. You can see that it is less than half of where it is normally. And this is not a story about high sales. Sales have actually backed off in the last couple of months. It's a story about production being greatly constrained by a lack of computer chips. So even with imports of semiconductors rising, it's going to take time to rebuild inventories for cars and other durable goods. So bottom line here is just that these constraints are going to be declining only gradually over the forecast period. Turning to supply of labor, as you can see in this chart, there's been an important divergence in labor force participation between working age adults who saw a drop in their participation, but participation is starting to come back, and older adults where participation dropped and really hasn't come back at all. And I think both groups are affected by a number of factors, ranging from virus fears to jobs that are unpleasant, particularly in pandemic times, and the financial buffers that I talked about earlier. But my best guess is that working age adults will mostly re-enter the labor force as their financial buffers dwindle. But we're going to see only a partial recovery for older workers because to the extent that they had 401k assets going into the pandemic, they've seen a real windfall with stock prices. And I also think they may be affected by the other factors, the virus fears and the unpleasant working conditions more than younger workers are. So that's the supply side, but it's not just the supply side that's evolving. I think the demand side is also evolving. Now, of course, the big story of the summer was that firms, particularly in the services sector, haven't been able to find workers. And the graph just shows you an example of how high job postings have been for minimally skilled workers. I think this is good news for these lower skilled workers. It means jobs are coming back for them, but I don't expect this situation to persist because, as I said, I think the working age adults are going to come back into the labor force. And because I don't think at the end of the day, we're going to see all the pre-pandemic jobs recreated, given restructuring, sectoral shifts, and an acceleration of automation. The implication being that I think by next summer, we're going to be seeing what we think of as a prolonged jobs recovery. Although the magnitude is still unclear because we just don't have great numbers on how much of this kind of structural shift is going on. So here's my labor market forecast. As you can see, or actually it's not in the slide, but I am assuming ongoing recovery in labor force participation, although not all the way back to its early 2020 level because of the early retirees staying out. I see the unemployment rate falling to 4% by the end of next year, and I see the employment population ratio recovering much of the way to a new normal level that's lower than the old level. So now let me talk about policy, starting with fiscal policy. So for all of the many hours that we're all spending reading about fiscal policy, I think the outcome of the debate around the spending bills is going to have actually limited income on the macroeconomy over the next 2 years. Now, this all assumes that the debt limit is raised this month, and I think it will be, but if not, there's some big downside risks if that happens, if it doesn't get raised. So I think the infrastructure bill will eventually pass. As for the reconciliation bill, big headline numbers have been thrown around about how much spending is involved. But the reason I don't think it's going to translate into much macro impact is, first of all, I think the final numbers are going to be smaller than the biggest numbers you're hearing right now. In fact, I think they're going to be far smaller. There's also going to be a partial offset with taxes because they'll pay for some of the spending, but then the amounts will be spent over 10 years. There will be some front loading, but it will be spread out over time. So when all is said and done, my forecast is assuming $150 billion of net new stimulus, which does offset some of the drag from the waning of earlier stimulus, but it's just not a big macro force. So let me go now to the very important topic of inflation and monetary policy. So I'm just going to qualify this whole discussion by saying there's just a lot of uncertainty about what's going on. And that's even true within PIIE, as Adam alluded to. You'll see divergent views. As I said before, core PCE inflation in the United States is at 3.6%. Headline PCE inflation is now higher than 4%. The left chart kind of shows you the good news, which is that if you look at the trimmed mean, which strips out all the stuff that's being swung around by supply issues, there's hardly any rise in that series. Now, of course, that's not the whole story. Prices are receding in some areas, but we have other areas we need to watch. So we need to keep an eye on rents because of the rapid increase in home prices. We need to keep an eye on prices for medical services. And we need to keep an eye on energy prices as seen at right, and as well as goods that use energy as an input. As if the last 18 months hadn't been humbling enough for forecasters, it's just really surprising. It's really striking how surprised people have been with what's gone on with this spike we've seen in oil and natural gas prices, especially given that we think that part of the story behind the increases is kind of slow moving forces like the change to green energy. But anyway, this is something we need to keep an eye on. In addition to watching actual price movements, we want to watch indicators that might tell us whether those price movements are going to be sustained. So big recent debate over inflation expectation measures. I think we all should acknowledge the measures have limitations. And even if we could actually measure inflation expectations, that's only one determinant of future inflation. Still, I think it's important to look at them. I have some key measures in the chart on the left here. You can see that some have jumped, but many remain in ranges that are just not that concerning. Likewise with wages, we have many measures of wages. They actually all have limitations. I'm showing you just one measure here, the Atlanta Fed Wage tracker, I like it because it adjusts for compositional changes in the labor force, and it's very timely. And it shows a limited rise in wages, but I want to acknowledge here that there are other measures that do show more of a gain. And there's just a lot we don't know about wages. For example, the degree to which incumbent workers are going to want higher wages because firms are raising wages for new workers. I guess the last thing I will say with wages is that it's worth keeping in mind that the high profit share right now means that higher wages do not necessarily have to result in higher prices. Anyway, this slide shows my inflation forecast. My inflation forecast is a bit above market consensus, somewhat more above where the FOMC consensus is right now, with core inflation rising to roughly 4% at the end of this year, before subsiding to 2.5% next year. And the basic story is that I see supply pressures, including worker shortages, easing, but only gradually. And I haven't seen evidence that we're shifting to a new regime where normal inflation is higher after decades of being in the 2% range or even kind of lower than 2%. So that just leaves me with monetary policy. Again, I think there's just a lot of uncertainty here related to all the uncertainty around inflation. But I think the most likely outcome is that the Fed will raise the funds rate before the end of 2022. This would be a little faster rise in the funds rate than what the FOMC consensus expects now. And I think the reason is that inflation will be higher. So just, no surprise on what they're going to do with tapering. I think it's going to begin soon, but I think we'll see one increase late last year and 3 more in 2023. We all hope for a soft landing when the Fed does this, but I will note there is a risk that markets could be surprised by the extent of the policy tightening, particularly if the Fed has to pivot abruptly. And that could cause dislocations in asset markets. I worry about the so-called everything bubble deflating, perhaps suddenly. And I will say that even when you think about adverse global consequences, even the absence of that kind of surprise, the higher rates may be a problem for lower income countries that have borrowed a lot, particularly if they're on the lower track of the 2-track recovery. So this just brings me to my conclusion. I'm not going to take you through this whole slide. It summarizes where I came out on the 5 key factors that I flagged as shaping the recovery. But I do want to say that even though I am optimistic we'll see continued global recovery, it's important to understand that there are important risks out there. There are just no similar episodes in history to guide us. And there is certainly downside risk for the potential related to the potential for new virus variants to emerge, the potential for new further supply shocks, and also the disruptions to financial markets that, as I just said, could be caused by central bank policy or by other factors. So I'm going to leave it there and stop sharing my slides and turn it over to John.
Thank you, Karen. Before we turn to John, just a reminder to everyone, this is on the record, and please feel free to our invited registered guests to put questions on the Q&A function on Zoom, not on the chat. Second, as Karen mentioned, there's a variety of views on inflation, and we're going to be presenting another one a week from today. Federal Reserve Bank of Atlanta President Raphael Bostic will be giving a speech on inflation at the Peterson Institute virtually. 12:30 p.m. Eastern Time, a week from today, October 12th. Karen mentioned the Atlanta Fed wage tracker, and obviously President Bostic will be drawing on that and other sources. Now, let me turn it over to Jean. Thank you.
Thank you. Thank you, Adam. There will be quite a lot of common themes between what I'm presenting and what Karen has presented. But let me, from the outset, emphasize one point. Usually, at least in recent times, the presentation about Europe starts with bad news and ends with bad news. And I think it's important to realize that these times are different. I will start with good news, and I will end with some questions that are going to echo those of Karen, but it's important to realize that the overall, so far, the policy performance in Europe has been much better than in the past. Let me start with the health situation. I think, as everybody knows, vaccination now in Europe is higher than in the US. Death rates are lower, both in the UK and in the European Union. And it's interesting to see that if you look at the graph on the left, that the stellar performance in Europe is this unlikely country, Portugal, which was so much in a dire situation not so long ago. So it's not just the Denmarks of the EU, it's also Spain and Portugal that are performing well. Second piece of good news, this is probably common to many countries, but with Olivier Blanchard, we did a systematic comparison of the cost of reducing the R ratio, so the contamination ratio, the trade-off between reducing it and having a negative impact on economic activity, if you wish, the economic price of reducing contamination. And already in the second lockdown, it was clear that this cost had been reduced enormously. What we're seeing now is that it has come to a very low level, despite the variant, economic activity being close to pre-crisis level or even at pre-crisis level in Europe, so which indicate that the learning has been there. Third piece of good news, and complementing what Karen just presented, these are not forecasts. This is the OECD Gdp Tracker. So the OECD has developed a weekly tracker of economic activity that mimics GDP, GDP being available with delay and on a quarterly basis. And there was a need for better high-frequency indicators. So this is what the OECD has developed on the basis of a series of indicators. And the performance in terms of tracking GDP, as indicated by the dot, is not that bad. So what does it tell you? It tells you that on the left, I have put the US and Germany, two countries where the initial drop in activity was limited to something like 15%, and that have recovered more or less very close to pre-crisis trend. It's not pre-crisis level, it's pre-crisis trend, taking into account the growth in potential output as projected before the crisis. But here you see on the right the two countries, France and Italy, where the drop in activity was much higher, between 20 and 30% initially in the first quarter of 2020, have also recovered more or less in the same way, which shows that growth rates are very misleading because they're geometric, they're not arithmetic. So you can have the impression that these growth rates differ considerably, but in fact, there is a lot of commonality in the way our economies have been able to recover and to come close to the pre-crisis trend. On the labor market side, the message is different. And here, I would contrast the US and Europe. Actually, the UK would also be on the European side. Most, if not all, European countries have adopted similar schemes of furlough. So putting workers on temporary idleness, but keeping the employment relationship and socializing the cost of maintaining employment despite companies having to stop production. The cost has proved to be limited, and the measure has proved to be very effective, both in limiting labor market disruptions and in providing household with an income security in a way that, in fact, hasn't been more costly than in the US, where you had to top up unemployment insurance in some cases, as shown by Karen, increasing the income of the workers. So I think the European way of doing it has been fairly good. And as you see, unemployment has not increased so much. And actually, unemployment is still, compared to pre-crisis level, in a better situation than in the US. An important factor has been the strong government support to business. And I would contrast, obviously, this support with the lack of reaction or the pro-cyclical reaction in the aftermath of the global financial crisis. So this is taken from a comprehensive report done by Benoît Cœuré for the French government on comparing the measures taken in Europe and in the US. So here I focus on the measures that were announced, and the actual outcome is a bit different, but it was important for government to announce large sums of money in order to impress and to ensure that expectations of regarding the future would remain strong, especially in the business sector. So the announced liquidity and guarantee measures were about in percentage of GDP, of the 2019 GDP, were in continental Europe and in the UK of the order of magnitude of 15 to 20% of GDP. Part of it was not used. In Germany, for example, the announced measures were far higher that was actually drawn on because the shock was limited and companies did not need to draw to such an extent to the announced measure, but it contributed to stabilizing the situation. And here there is also a contrast with the US, where those liquidity measures were less generous. The fiscal measures, so budgetary transfer, not just liquidity, were also significant in Europe, about the same order of magnitude that in the US. So again, that helped the business sector, especially during the second lockdown, I mean, in 2020, end of 2020, beginning of 2021, they helped the business sector to weather the crisis at a time where liquidity was just not enough anymore. So that was a bit sort of, whatever it costs phase. And I think, surprisingly, Europe did not behave in a piecemeal way we used to. All countries, it provided wholesale support with, obviously, the support of the ECB. Because government could not enter into such scheme, or some of them actually could not, without having the support of the ECB. And the ECB, the graph on the left shows the balance sheet of the ECB, which indicates it started in 2005. So it indicates how long it took for the ECB to start really proper quantitative easing. It started it only in 2015, 1st January 2015. But then for this crisis, it started its pandemic program and deployed its pandemic program at very high speed. With also the flexibility in the allocation of purchases that made it possible to keep spreads between the various sovereign states in the euro area compressed. The graph on the right shows the bond spread between Italy and Germany. And after initial miscommunication by the ECB, this spread was brought down to a level to 100 basis points that made it possible for Italy to do what it needed to do to support its economy. Longer term, the EU also launched this much discussed Next Generation EU plan, which is essentially the EU borrowing to grant, lend, and transfer to the member states. And here I focus on what Mario Draghi did with this plan, because I think that's very interesting that this country that had suffered so much from the previous crisis, the Eurozone crisis, found a way to leverage the transfer from the EU and to launch something that's really impressive in terms of size and in terms of scope. So the plan launched by Mario Draghi includes the grants from the EU, so that's grants allocated to Italy on the basis of economic and social criteria, plus loans that were available from the EU, which Italy has announced its intention to draw on the whole range of loans available. So, plus some national borrowing on top of the EU loans. So to launch a plan totaling 13% of GDP. And on the right, you have the composition of this, the resources of the Italian recovery plan, which is really a sort of very shock and ambitious strategy with a number of priorities and something that's medium-term oriented that makes Italy, instead of having this sort of very cautious response and looking at the market reaction to see if it can go further or has to backtrack, Italy has been able to do much more. And I think that's a reason to be hopeful that this strategy may lead to structural improvement of the Italian growth performance. At least the means are there now. It's a question of implementation. In terms of the fiscal stance, also, Italy is a country that tightened significantly. That the red bars on the right that tightened significantly its fiscal policy in 2011, 2012, and it's not doing that at all this time. Finally, to turn to what Karen rightly emphasized, this strange situation where we have a number of bottlenecks. I'm using here a survey of French companies that was initiated at the time of the early first lockdown, asking companies why what is the situation and why. And what you see here, the green part are companies doing well. The dark green is companies actually having expanded their production, and the yellow, those having decreased production, and the red having decreased production by more than 50%, and then the brown is those having stopped production. You see that situation has massively improved, obviously, but you still have a number of companies that are struggling because the production has decreased significantly. And if you look at what are the reasons for it, and this is the next slide, the reason for having stopped or reduced production, it's a combination of demand deficit that's prevalent, a bit about 50%, a bit more, and it has been more at earlier stages, but also some remaining administrative restriction, some supply shortages, and some labor shortages. So you're seeing here that the nature of the constraints is shifting with more coming from labor shortages. And that's for companies whose output declined. Now, if you look at in general, all companies, and the reason why they see obstacles, the obstacle they mention to further expansion, the bar here, the bars indicate the supply constraints. And you see the supply constraints rising quite fast. At the same time, the demand constraints at the orange curve and the financial constraints declining. So that's very much echoes what Karen said about the nature of what's happening with the increasing prevalence of shortages and bottlenecks. Now, I focused on quantity indicators, not on prices, because we see more happening on quantity indicators these days in Europe, at least. I mean, in the US, you see more on the price side. But that tells us, what sort of question we should be asking about the medium term. My interpretation is very much in line with that of Karen. And we're in a post-traumatic phase. So the labor market, shortages, international trade costs, relative prices, the price of energy, all have been shaken, put out of balance, if you wish, by this crisis. It is a massive commotion, and the economy is in an adjustment phase. So we don't know how long it will take to adjust. We don't know whether some of those obstacles will remain more persistent. If you ask yourself what the consequence of this shock for potential output, there are potentially persistent sectoral effects. Some sectors are lastingly not out of business, but in a constrained situation. Think of long distance travel, think of the aerospace industry, etc. So there are some persistent sectoral effects, but at the same time, there are some potentially positive productivity effects. The very fact that companies had to learn how to work, how to function differently, the very fact that they had to accelerate the digitalization is a productivity positive. And how those two effects in one direction and the other are going to play out is a big uncertainty going forward. So I think it's wise to look at the situation as having a strong element of uncertainty and accepting that the outcome will depend on how these factors play out, and to leave room for this adjustment. The one reason for worry that's particular to Europe that I would have to emphasize, is the fact that this acceleration that we're seeing is not something easy for Europe in terms of the sectoral specialization, in terms of its ability to reallocate labor, in terms of its innovation capacity. So the big question to me is, will it adapt structurally? Now, in the meantime, we have, as I said, a medium-term oriented fiscal policy and a look-through attitude of the ECB, of the central banks. That's, in my view, is likely to continue to prevail for some time at least, which means that I will end with these questions, but more on the positive side as regards the outlook for Europe. Thank you.
Thank you, Jean. I'm aware the time is ticking, so let me turn right to Martin and his analysis of China's changes.
Thank you, Adam. I'm going to continue a little bit of the positive take and contrast a little bit with some of the apocalyptic headlines on my area that we're going to explore here, rectification of technology in China. There's been a dizzying array of initiatives coming out of China's government that have raised party control and increased regulation in a broad variety of sectors. I don't have nearly enough time to go through all of them. That would take probably a few days. But I would say it starts with the cancellation of Ant Group's IPO. That was supposed to be a world record in November of last year, and then really intensified this summer around the time that there was a cyber policy crackdown on Didi, which had just done an IPO in New York. This is expanded to antitrust, privacy laws, labor laws, tech CEO departures. In finance, we've seen a tightening of credit to real estate, which is not exactly in the technology area, but related to this general regulatory storm. Regulations on internet content and ideology, and then also attacks on inequality, including the elimination of a $100 billion sector of private sector tutoring, with the idea that that was perpetuating educational inequality. How do we make sense of what's happened here? Pressure has long been building inside China to end what I call a Wild West under an authoritarian regime. There was actually quite limited regulation and enforcement of regulation on China's tech sector for a long time. That's obviously with the exception of strict censorship regimes. But progress to move on this area was quite slow for a long time, mainly because there was strong political backing for the tech companies who could credibly say that they were national champions helping advance China's technology development and modernization. But then Jack Ma gives this speech in October 2020, and I think that really broke the dam and led to a deluge of regulations soon afterwards by changing the political cost benefit of tech regulations. So he criticized regulators for having too many rules on financial side that was harming innovation. And the party perceived that as an oligarchic public attack on their ability to implement regulations that they thought were critical towards financial stability. And the negative public perception of Jack Ma's speech broke some of the view of invincibility and the popular support that had protected them for a long time. But many of these rules that, when I look at them, don't look like punitive attacks on Jack Ma and his companies. They look more like sensible policy responses that required years of debate and careful thinking, like the Personal Information Protection Law went through many rounds of revision over many years at the National People's Congress before it was passed. And now that there's the right political moment, many of these things can come out that regulators have been thinking of for quite a long time. Many of the specific goals and policies that are part of this regulatory storm would actually be welcomed by many in the US and Europe. One of the ways that you can think about as a mental model is that the Chinese government considers that these major tech platforms have become more pieces of essential infrastructure that need more regulation and not just regular private company services, because so much of the digital economy runs on them and through the piece of what they've built. There are rules on accumulation of data, which are of international relevance, and barring unfair competition on internet marketplaces. Those later two, in quotes, could have easily come from a state council document in China, but they're actually from a Biden administration executive order, just giving you an idea of how similar many of the motivations are, even if the tools are sometimes different. This really does represent a major break, a new regime with more party control over the economy and especially the online space. Politics has been a key driver here, as alluded to a little bit previously. The way that these things work in China is that we just don't know the length of the campaign and its extent, and I just don't think that there is a master plan in the party leadership in Zhongnanhai that has a clear list of sectors that they're going to crack down on and exactly how far they're going to go. Instead, what they do is they release these high-level, relatively low-content kinds of initiatives. So one of these is the preventing the disorderly expansion of capital through anti-monopoly that came out soon after the Jack Ma speech. And then common prosperity, focused on inequality. We also have dual circulation, which is focused on self-reliance. But then how that actually gets implemented is a dynamic process where the bureaucracy sees these signals and then has to figure out what is too far, what is not far enough. They want to demonstrate that they're actually part of the leadership's and initiatives. It's consistent with the longstanding patterns in China's political economy. Lax regulation for a long time and then campaign-style crackdowns. That's something I've found in my work on fintech, my forthcoming book, and also the shift in regime for a long time, just getting the government out of the way, letting a market grow up. And then when it's grown up, the government decides to try and create the conditions to make the market work. That's something that Dynan has figured out in her work. Then before major party congresses, the next one is going to be in fall of next year. There are major moves. This is in particularly important because there is the next party congress is widely believed to lead to a precedent-breaking third term by Xi Jinping, and he wants to demonstrate with this ambitious policy agenda a pitch to break with this tradition so that he's able to implement this ambitious agenda. And then a shift towards more granular industrial policy has been in the works in China for about a decade now. Barry Naughton calls that grand steerage. We're still, I think, in the very early innings. There's another year until the 20th Party Congress. Now onto the forecasting side of this, the potential impact on the private sector and the economy. We know China needs to rely much more on productivity for future growth because the returns on capital have been going down and the working age population is in decline. They're very worried about the latter, especially, but there's really nothing the leadership can do about it in the near term. So we have to think what impact is this going to have on productivity. Well, there's a huge decline in big tech market value, maybe about $1 trillion already. But this is a bit of an ambiguous signal because there's too little data to see whether this impact, whether there's a large negative impact from all this uncertainty on investment and innovation throughout the economy. And I would actually point out some of the more real-time data on venture capital and PE investment in China is actually quite strong and shows that there's already been a longstanding shift away from these consumer internet sectors that are getting cracked down on and more towards the hard technology sectors. And the campaign's public perception is generally positive. People see it as responding to real socioeconomic issues, not as cracking down on entrepreneurs who criticize the party. One important dog that hasn't been barking here, in my view, is we haven't seen measures that are rebalancing the economy towards inefficient SOEs that you would expect would really hit growth hard. Mainly these initiatives have hit private sector companies, but I would argue that's because these are areas where the regulation was much less than what might be needed considering the size of the sector. Then there are some potential growth boosting factors in some of this if the party is able to make this work out right, which is they think that cracking down on monopolies and dominant platforms is actually going to increase innovation by allowing more competition from a younger group of firms. They think it's going to allocate more capital towards hard technology that they think is going to benefit the economy more in the near term. We don't really know how it's going to turn out, but that's what they see as their goal. There are more concerning areas of this. One is the government taking direct board seats and stakes in companies. That's been quite limited thus far, just in internet content companies. But if they expand it and start to micromanage firms, we would expect that to be very negative for growth. Another is forced contributions to common prosperity and charity. If that begins to take money away from productive investments, it could be problematic for growth. And then now there are some ideas that they're going to nationalize tech firms' data that would mess with incentives in the sector and cause all sorts of issues if they expand that beyond the narrow credit area that we've been talking about so far. The areas, this is no longer technology policy, but the areas that I think they've taken actions that are more impact on the growth outlook is in the real estate credit crunch, which has caused the Evergrande situation, and environmental policy, which has they've bungled a bit and has led to some power outages that are causing problems in industry and for people. I would note that the rapidity and scope of this campaign raise the risk of large unintended consequences. And generally, all these controls and ideology, I think, are problematic from a moral perspective, but don't necessarily hit the economy. But one way that they would hit the economy is that the shrinking space for criticism, like Jack Ma's intervention last year, cuts off a key feedback mechanism that would let the party know that they might be taking something too far, or that one of its policies might not be fully well thought through. If we have more actions in this area, we might kind of on this set of bullets might signal a more aggressive and damaging campaign to growth. So overall, I really think that the current narrative overstates the economic hit of all of these technology regulations. My base case is a moderate hit to growth in the short term. That's mainly coming from the environmental side and the real estate credit crunch side. Real estate is about 25% of the economy. I really don't think that the uncertainty related to the tech sector is really causing that much of a decline in the growth outlook. There is significant downside risk in the medium term if they take too much on their plate, if they're not able to manage this transition well, and if instead of increasing competition, maybe state companies come in and take over and use their political influence. I'll end with some ideas about what the impact would be on the rest of the world. As it doubles down on self-reliance, I think there will be reduced access to China's market, which is going to raise the tension with trading partners, especially the United States. Then Chinese markets slow down in areas like real estate would negatively impact supplier countries and the global economy. And finally, just a thought experiment, if the campaign slows down China's innovation by holding down its most innovative companies, it would give the US and its allies more time to maintain the current technological capability gap with China. But if they're succeeding and they're able to actually create a more vibrant technology sector as a result, then the opposite would be true. And that would be a source of nervousness for Washington that maybe people are not thinking about enough now. Thank you.
Thank you very much, Martin, and thanks to all our speakers and to our engaged audience. We're about to run out of time, so I'm going to do a lightning round of one question for each speaker and ask for a quick response. Thanks to Karen and John, who are already typing answers to some of the good questions posed by our participants on the Q&A function. Karen, just quickly, what are your thoughts on the word stagflation? We know noted people like Rubini and Summers are talking about it right now. Do you think that term applies? Does it do any good? Unmute, please.
Let me try a quick answer on that one. If you're defining stagflation as low employment and high inflation, I guess technically it might apply. I don't actually use that term for a couple of reasons. First, to get technical, output is actually above trend or heading above trend. So that hardly seems like stagflation. Second, I think the word just comes with this baggage that connotes the 1970s where you have kind of ever rising inflation. I just don't think that's a risk, because I think central banks are going to, if it started to happen, I think central banks would jump on it. But third, and I think this is probably the most substantive point, is that I associate stagflation with this idea that central banks have no choice but to face an ugly trade-off between kind of raising rates and therefore tanking employment, taking care of inflation, or helping with employment and suffering inflation. I don't think we're in that situation right now. So first of all, inflation may subside as it does in my forecast. But more importantly, I think central banks, I think they're more willing to tolerate a little higher inflation than they did. That's partly because of the lesson in the 2010s that, like, if you're low on employment, that has huge costs. So you got to be taking that into account. But secondly, I think as you mentioned me, Adam, the papers at Jackson Hole this year kind of flagged the fact that kind of higher inflation would be good to the extent the economies need to do reallocation.
Thank you, Karen. John, just quickly, I think for a lot of our audience, hearing so many good news slides about Europe is unfamiliar. You mentioned the ECB as a downside risk. Is there any other downside risk in the near term, leaving aside the disease, which obviously we cannot forecast? But is there anything else you would consider a major downside risk in the next year or two?
Well, apart from the general risks we have emphasized, perhaps your question is about policy. I don't think the likelihood of policy shifting in a way that would be, overly restrictive, panicking in view of some indicators. I don't think that's very likely. That remains possible. There is a policy debate, both on the fiscal and on the monetary side. But I think that the likelihood is that the debate will go on, and we're going to avoid, making the mistakes you could think of.
That's great. Thank you, Jean. Martin, finally to you. You sort of touched on this in the end. There's obviously a lot of attention being paid, not just to China's deliberate crackdowns or restructuring or whatever you were calling it in the tech sector and digital, but we have the breaking news of the Evergrande. How do you see any prospects for major shocks arising out of that, and any rapid change in the real estate sector in China? And again, lightning round.
Yeah, I don't think we're going to see any lightning changes or quick shifts there. My sense is that there's been a long-standing battle in China to try and reduce moral hazard and reduce financial risk. But if they do it too much at once, they create too much stress. So I think they'll continue. They've really proven their ability to manage difficult crises before, and I think they'll continue to do so in the Evergrande situation. It's going to be more of a slow burn than some quick bankruptcy process where state firms are able to come in all throughout the country and help buy up pieces of it and spread the debt burden. And I don't necessarily see it as causing a huge dislocation in the property sector, although it's slowed down. It's a little bit of a drag, but it's not. I don't think it's really the kind of risk of a financial crisis that some people are worried about.
Terrific. Thank you, Martin. Thank you, Jean, and thank you especially, Karen. With thanks to all of our audience, this is of course totally on the record. Karen, John, and Martin's slides will be up on the PIIE website. In fact, I think they are already. Sorry we couldn't get in more of people's questions. Please feel free to reach out directly to the fellows to engage. And we look forward to seeing those of you who wish to join us next week for another discussion of U.S. inflation with Federal Reserve Bank of Atlanta President Raphael Bostic on Tuesday. But we look forward to seeing all of you on an ongoing basis, and in 6 months, another Global Economic Prospects from the Peterson Institute.